2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Windsor Gardens or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We have spoken a bit on Fear and Greed about private credit, but not a lot about listed investment trusts focused on private credit. Certainly, there is a surge of interest in private credit as investors go in search of higher returns. Last week, MA Financial Group listed its first listed investment trust focused on private credit. I wanted to take a closer look at it and LITs generally, how they work, how investors should think about them, where they might fit into an investment strategy. Also, the pros and cons of listed investment trusts as a way into private credit. Remember, this is general information only. You should always seek professional advice before making investment decisions. Frank Danieli is the Managing Director, Head of Credit Investments and Lending at MA Financial Group, a terrific supporter of this podcast. Frank, welcome to Fear and Greed.
Sean, great to be here.
Let's start with a 101 on listed investment trusts, and then we'll go into why you're focusing on private credit.
Sure. Well, listed investment trusts are basically a fund that is listed on the ASX. And so what it enables people to do is to buy and sell units in that fund the same way they can buy and sell units in a company.
Okay. And then that listed investment trust has a bunch of assets or a style of asset that it invests in. So in this case, we're talking private credit. Is that right?
That's right. In the case of MA1, it's private credit as the underlying assets. And so instead of owning a piece of a company, what you own is a unit, a piece, or participation in a fund that does, in this case, private credit.
So what are the underlying assets you're talking about? So if I go to and buy an MA1 unit on the ASX, I'm interested in what private credit, so what the managers of it are investing in. So what are you investing in?
Yeah, so MA1 provides exposure to what we call our flagship private credit strategies. So at MA, we manage about $5.5 billion of private credit out of $10 billion in total assets under management. About $4 billion of that capital we run in private credit is what we call our flagship strategies. So they're our most established, prominent strategies. And that's what MA1 participates in. So MA1's not, it's a new way to access those flagship funds, but it's not new per se. These portfolios have been going around, been operating for a long time. And so that's what investors get exposure to. So there's 165 loans in the book of about that $4 billion odd underlying portfolio. It's across 16 different segments of lending. So it's really diversified across a lot of things. What it is, at the highest level, in private credit, what is it really? Private credit is it's a loan, a private loan that is made directly by a fund manager on behalf of a fund to a borrower. And it's just not a bond or it's not a loan that's on a bank balance sheet. That's really what it is. It sounds probably more complicated than what it actually is. The specific types of private credit we do in MA1, we do really 3 things. So direct asset lending, which means we make a loan senior secured against a physical asset. So think about real estate credit. I mean, imagine there's a building over there. We go and make a loan to it, an apartment building, for example. And we generally try and do that at a pretty sensible loan to value ratio. Similarly, we might make a loan directly to a company. It's the same kind of thing. There's a company over there. We go and make a loan senior secured to it. So we're senior in the capital structure to the equity. If your listeners are familiar with shares, we're senior to the shares. So
if it all goes wrong, you get paid before the equity holders get paid.
Well, that's the idea of lending. We like to say, and our philosophy is that credit's about avoiding losers and not picking winners.
Yeah.
When we make a loan, we would put $100 out the door. We want to get $100 back with high probability, and we want to receive the interest that we're entitled to along the way, again, with a very high probability. We want a borrower that can service those loans. That's basically the way we think about what we're doing, and we want to make sure we're not the meat in the sandwich, Sean, as you say, if things do go wrong.
Okay, so I interrupt you there. So there's type of loan which is secured against real estate or against an asset. Yeah. There's a direct loan. What's the third one?
The third one we call asset-backed lending. And so this is basically where we finance a whole portfolio of loans, and we generally do it ourselves, providing a capital to finance those large portfolios of loans in partnership with a bank and a specialist lender. So this can be in areas like we do certain types of home loans. Think about, say, self-managed super fund home loans, for example. It could be car loans, business loans, asset finance, or things that are a bit more specialized like receivables finance. This asset-based finance, I just think about it as basically real-world economy lending. It's just lending, all those things that I mentioned there that I'm sure your listeners are pretty familiar with.
Yep.
Providing finance in the real-world economy and doing it in a way where it makes the most sense, that it's done not just by a bank directly out to a customer, but actually by a specialist lender that then needs to get capital from a credit fund like us and maybe actually a bank as well.
And do you discount any particular sectors or any particular credit grades or anything like that?
Look, we do. I mean, we've put a lot of day one information about the portfolio here. We do a whole bunch of risk grading on an ongoing basis about the credit quality and all that sort of thing. We do a lot of analysis and stress testing of our portfolios. We do this thing twice a year we call war games, where we basically do this huge stress testing exercise of our portfolio. Happy to talk about that. So we're doing all those kind of things. And you asked the question, I guess, Sean, do we discount certain types of lending? We think that when you're lending, what's really happening here and why private credit's emerging is that there's just these areas of lending where banks aren't the efficient provider of capital either anymore or ever. And that's what you're sort of lending into that space. Now, you have to think the way a bank would. And the way a bank thinks is they think about what their portfolio is exposed to, and they might want to lend more in a certain sector at a given time and less in others, because there's different relative value or different performance characteristics. And I think it's incumbent on being a private credit manager that you have to do the same. So we spend a lot of time on portfolio management and thinking about what sectors we want to be in and not want to be in, and where we're leaning into and where we're not. I said we've got 16 different subsegments of lending in this portfolio today. We're adjusting things all the time.
Okay, Frank, stay with me. We'll be back in a moment.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Blair Athol or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
I'm speaking to Frank Danieli from MA Financial Group. Okay, so in a sense, before the break, we've talked about the ins and outs of your listed investment trust focused on private credit, MA1, on the exchange. Firstly, what are the upsides for investors in doing it via a listed investment trust as opposed to a managed fund or something like that?
Well, the key difference is basically that you can buy and sell units on the exchange. And so it has a different liquidity profile. So for investors where that's really important, where for the ability to actually buy or sell a unit is important, then they can do that and they can participate on the exchange. Obviously, we already run a series of private, meaning unlisted credit funds today, and they will just have different liquidity characteristics, where timing that you can get in and get out relative to what a listed fund can do.
What are the downsides of investing in private credit? Well, the upsides and downsides, why has there been an explosion of it to begin with? And certainly people are rushing towards it, they have been rushing towards it, enough for the regulator to say, hold on, I'm just going to keep it up. We need to keep an eye on this. So I'm just interested in the upsides and then the downside, the risk.
Yeah, well, look, the fundamentals of credit generally is credit should be boring. And so the idea of credit is, I told you I was going to pay you, in the case of MA1, cash rate plus 4.25% or, 8.35% per annum. And really what you want in credit is you just get that. You don't, it's not the equity part of your portfolio is where you should be experiencing growth and those sort of things, compound returns. Credit's just about ideally being boring as you can. Why are people investing in private credit though? I think it is people do want a part of their portfolio where you have yield, income. It's an income part of the portfolio. Now, historically, people would do that. Think about a traditional 60-40 portfolio. People would get the income defensive component from bonds or traditional fixed income. What private credit really is just an alternative to that, where you can participate in this thematic I mentioned that's going on, where there's emergence of these areas of lending where private funds can be a more efficient lender in certain parts of the market. And investors are participating in that because they like the premium they get, the step up in return that you generally get by doing that activity relative to traditional fixed income like bonds. And that's really been the attraction. I think what's also happened is that there's been a bit of a democratization of this space. The way that you can participate has opened up. There's many more ways now to participate, and listed investment trusts are a good example where it's opened up to just, more people because it is on the ASX than what you traditionally have. This, used to be the domain of, very, very large institutions. And over time, there's just more ways to access it. The same thing's happening actually in other parts of the market, like in private equity and so on. There seems to be a real dynamic emerging, and we really believe in it, that there's just going to be a part of people's portfolio where they're happy to say, you know what, maybe I need a little bit either less liquidity, or I can trade something off and I can get a premium return. And that's what they're doing.
Yeah, the sort of 60-40 idea seems to be going the way of the dodo a bit. The hybrid market at the moment, banks are pulling out of it because of new regulations, but we're seeing corporate hybrids, certainly private equity, you mentioned private credit. It just seems that there are lots of different instruments opening up to high net worth individuals, family offices, retail investors that were never there before.
Yeah, look, a lot of people do talk about the death of the 60-40 portfolio. My strong view is that actually 60-40 is a really good way to manage your portfolio. It's just that what's in the 60 and what's in the 40 needs to change. And that's because there are these really big now private markets that have opened up, and the ability to participate in those can be quite attractive for investors. The other thing, and you mentioned, Sean, there, that there's just different ways to access it too, that's important. What something like a listed investment trust demonstrates is that these two markets can actually converge. Public and private markets can actually work together pretty well.
Frank, thank you for talking to Fear and Greed.
Thanks, Sean. It's been great.
That was Frank Danieli, Managing Director, Head of Credit Investments and Lending at MA Financial Group, a great supporter of this podcast. This is the Fear and Greed Business Interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Blair Athol or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.